A very good evening to you all, and welcome to the 12th episode of Market Replay. If you are tuning in for the first time, I am your host, Koketso Diklakanyani, founder of Ace Forex Academy, as well as the Chief Technical Analyst. Right, just to shed some light on what I strive to deliver through these videos, and that's simply to give you guys my perspective and my understanding of how the market works and how to trade the market. How I will be doing that is that I'll be reviewing a day's worth of price information in the form of candlesticks, and from that information I will then be highlighting the different trading opportunities that were presented to us over a particular day which relate to that specific currency. For today's episode, we will be looking at the Australian dollar against the United States dollar, and we'll be looking at the hourly time frame. Okay, not to waste any more time further, we shall continue. Like with every other video that I post, I like to start off by identifying the trend, right? The day started off bearish, but then the bears didn't have power to continue the day in the downtrend, and the bulls then kicked in and continued to push price to the upside. They gave us our series of higher lows and higher highs, and continued to give us our series of higher highs and higher lows, right? And then we had a very long consolidation period, which I'm marking out over here, right? This is our consolidation period before the breakout continued to the upside, right? And once the breakout then continued, price continued then to move upwards, right? And from that breakout, we then had another moment of consolidation, and a breakout continued, right? Let's just highlight the moment of consolidation. Okay, and then price broke out to the upside. Okay, and then what we then had was a further push to the upside, with the day closing off in this big consolidation period that we have, right? Which is this period over here. Okay, and that's how my day closed off, right? Like I've been pointing out in previous videos, that to us, consolidation is where we are given the chance to enter the market, right? You do not want to enter while the market is rallying, and you do not want to enter while it's falling. You have to wait for price to take a pause, which is then marked out by consolidation periods where steam is gathered and then trend continues or changes. But in these cases, what we can then see is a trend continued. Okay, let's visit these different consolidation zones, and let's have a further understanding of what actually happened and how we could have taken these trading opportunities, right? We'll start with our first zone, which is over here, right? Let's move on to a lower time frame. Okay, standard operating procedure. What we then do is start on the left before we go right. Okay, and looking on our left hand side, we have the formation of a swing high, right? Now what the swing high presents to us is our area of resistance, which also denotes an area of supply, right? And that then tells us that we have sellers that are parked within this particular region that may overwhelm the buyers should price push here and push the price back to the downside. Okay, and that's enough information to then give us a possible heads up of what might happen in the future, right? And that's why we then forecast our resistance zone right to the left hand side. And from that, what we can then see that is very interesting is the formation of a classic fake out. Okay, and with the formation of a classic fake out, we can then understand and pull out our modified Fibonacci tool, right? And let's have a measure. Now we took a buy on this position, right? And for two main reasons really. Number one, we had an obvious setup which met our rules, and that was a fake out, right? And number two, when we have a further look at our profit targets, what we can then see is that the 1:1 profit target, which is the minimum that we aim for, as well as the 1:2 risk reward profit target, fall way below our resistance zone. And that then gives us the signal that it's quite safe to enter this particular trade, right? Because we have not forecasted our profit targets into the possible turnaround point, which is marked by our resistance level. Okay, so price then closed on the outside and closed back over our support level, and we took a buy, right? And upon taking the buy, what we can then see is that price hit our TP1, which has our minimum of 1:1 risk reward that we're aiming for. And then with the protection of a positive stop, we can then see price continue to push to the upside, and this particular trade then delivered a risk reward ratio that far exceeds 1:2. So this was a very good trade to take. We were happy and the outcome was great. Minimal risk but maximum reward, and it was that simple. Not overcomplicating it by looking at too many factors, but by simply understanding our history and then forecasting it into the future. Right? We can move on to the next setup. Let's just clear up the chart. And this is our next zone that we have over here. Let's move to a lower time frame. What we can then see is the same. So firstly, you start on the left, okay? Highlight your swing high. All right, and then after highlighting your swing high, what you then do is forecast your area of resistance into the future. Okay, it's our area of resistance, and we are going to forecast that into the future. And what then that tells us is that we have an area of supply, right? Basic supply and demand principles. I always allude to this example that if you are owning a market stall, you would want to sell your goods at a very high price. Okay, and in the markets, when we look at charts, that very high price is then represented by our area of resistance, which then gives us our area of supply. Because we know that sellers are parked here because this is considered as a high price, we know that we have a probability of price turning around once they enter this region or breaking out and then coming back down. Okay, so with that understanding, we can then further go on to spot another setup that we have, which is the classic fake out. Okay, and pulling out our modified Fibonacci, what we can then see is that when we forecast this particular position, okay, I'll take profit targets. What we can then see again is that it meets our criteria, right? Number one, our minimum risk reward ratio that we strive for, which is 1:1, is met, right? Because it sits far below our resistance level, right? And then our 1:2 then is the one that sits outside, and we will be cautious when we try and attempt to go for 1:2, because remember, we don't know how price will interact with this region that we have marked out. So taking a buy on the close of this bullish candle, we can then see that price easily reached 1:1 as there was a lot of momentum towards the upside, right? And then price then further pushed, and because we had a protected stop, a positive stop loss placed there, price then went on to hit 1:2 risk reward ratio in this particular trade. So yet again, this was a very good trade to take. Very simple. The setup was out there and the setup was very easy to identify, right? We had our classic fake out, and then we had our entry reasons. It's that simple. No need to overcomplicate things, right? It's all about understanding history and then forecasting it into the future, right? Let's move on to our next zone. Let's just clear up the chart. and this is our last consolidation zone. And let's move down and have a look. Right, standard operating procedure, we want to start on our left, right? So by starting on our left, we are then able to identify our swing high, which then gives us the ability of forecasting an area of resistance, which also represents an area of supply, right? And with that understanding, we then pull out our modified Fibonacci tool, right, and forecast this move towards the upside. Okay, and as our strategy works, what we then do is that we wait for a retracement that exceeds 50%, right? We are not interested in any shallow retracements. We are only interested in retracements that exceed 50%, and we can see we have that on the close of this bearish candle, right? And what this particular setup then showed to us was that all we had to wait for was a confirmatory close past this high. Okay, and that came in the form of this bullish candlestick. However, what we then notice is that even though we have a confirmatory close, it's too close to our area of resistance. So we were not interested in this particular trade because we could not forecast a good risk reward ratio, as we had price coming into a zone that was previously rejected. And it's that simple, right? We do not overcomplicate it once again, and we just take the chart and the trade as it comes. Okay, so we have one missed opportunity because price then went on further and hit 100% and turned back to the downside. But that's how the market works. You win some and you lose some. Okay, let's have a look at the wider picture. What we can then see is that we had a very bullish day for the Australian dollar against the United States dollar on the 27th, right, which was our Monday. Okay, we had a very bullish day, right, for the Australian dollar. We were presented with 3 trading opportunities and we managed to score on 2, with both of them giving us a risk reward ratio that far exceeds our minimum of 1:1. So we were very happy on our Monday from the particular setups that the market had given. And that brings us to the end of this episode, right? If you found the video to be very helpful, insightful, and it aiding you in understanding the language of candlesticks, please do like the video and subscribe to the channel. If you want me to review a particular currency pair in the next episode, please do drop your suggestion in the comment section of the video. And once again, please do hit the bell notification icon so that you are notified every time I upload a new episode. Ladies and gentlemen, thank you for tuning in to the 12th episode of Market Replay. I'll see you on the next one. Cheers.